Most people think the stock market is made up of hundreds of companies, spread across sectors and industries. But when you actually look at the data, a very different picture emerges. In the US, the top 10 companies in the S&P 500 control nearly 30% of the entire index. That means just 10 stocks influence almost 1/3 of what most people call the market. In the NASDAQ 100, the top 10 stocks make up around 55 to 60% of the index. And this isn't just an American story. In India's NIFTY 50, the top 10 companies account for more than 60% of total index weight. In the FTSE 100 in the UK, the top 10 represent about 45%. And in the Hang Seng Index, a small group of tech and financial giants dominates most of the movement. Across global markets, concentration isn't the exception anymore, it's the structure. Now here's where things get interesting. Most global capital today flows through passive investing, index funds, and ETFs that buy stocks automatically based on their weight. This creates a feedback loop. A stock goes up, its weight in the index increases. Passive funds are forced to buy more of it. That buying pushes the stock higher, and the cycle repeats. This means price doesn't always move because fundamentals improved. Sometimes it moves because money had no choice but to buy. Over time, this concentrates more power into fewer companies. But concentration isn't just a performance story, it's also a risk story. During market drawdowns, the same mechanism works in reverse. If a heavily weighted stock falls, index funds must sell more of it. That selling pressure amplifies losses across the entire market. In extreme cases, a handful of companies can drag down national indexes, even if hundreds of smaller firms are doing fine. This also explains country-level concentration. The market hasn't disappeared, it has just become more centralized and quieter about it. Found this insightful? Subscribe to Finspread for more daily videos like this.